At the risk, Ron, of sounding like I am gushing, could the economy be any better than this?
Well, it could always be a little better. I mean, could it be hotter? Yes. Could it be? Could
but
more
hotter
people
doesn't
who
mean
want
better
jobs,
necessarily.
Right. It could mean more inflation or something like that. Look, I mean, I hesitate to use the Goldilocks descriptor, but right now, it's pretty close. You're at full employment. You don't have inflationary pressures. You have more jobs than you have workers. It's a nice position to be in. I think a lot of it had to do with the Fed pulling back at the end of last year and not moving forward with interest rate increases. And obviously, listen, you have to give the president his due. Some of these policies may be having a salutary effect on the economy. So we are where we are. And, you know, you get the credit and you get the blame when you're sitting at the top of this.
Same
right
question
now,
for you,
right.
Joe Duran. Does it get any better than this?
Well, yes, of course, it can get better, but not something that we should rationally expect. I think what we're seeing so far this year is an overreaction at the end of last year, the Fed course correcting, and now the Fed basically saying we're not going to do that again. And so they're going to be careful, and there's not a lot of reasons. Again, I think valuations look a little frothy here. You know, we're at 17 times forward earnings. So we're back where we were prior to that 20% correction, the brief one we had at the end of last year. But the Fed is in a different position. And so, again, I think things look great. Europe and the rest of the world is much slower. If they start to recover, that would be the dream scenario for me. That we start to see the rest of the world catch up, that will automatically raise rates because the U.S.'s rates are so low because compared to the rest of the world, we're growing a lot quicker. But that would be the thing that's missing, the global growth that I think that kicks in for the rest of the year. We're in great shape.
But Goldilocks here in the U.S., Ron, is pretty darn good. And when we take a look at the message of the markets in today's session, its growth is back on. You've got the tech trade on. You've got the Russell 2000 outperforming the S&P 500 right now. The very cyclical sectors like consumer discretionary are up. Is that the trade to be in at this point with this Goldilocks scenario?
Well, we talked about the quality trade before. I think that's important. If the dollar continues to appreciate against overseas currencies, you probably do have to gravitate back towards small cap stocks because they have more domestic rather than overseas exposure. So that's a logical trade. If the dollar were to weaken, you could go overseas and stay with that tactical trade about picking up some alpha in emerging market type economies. You do need China, though, to quicken the pace of growth if we want to see kind of a complete synchronization in global growth, and that's the part we're still waiting on.
The Chinese market couldn't be hotter.
Well, remember, it's still down, 50% from 2015 or thereabouts. It's rebounded nicely, since November of last year, up more than about 30% off its lows. So, yeah, but there's as much as they're growing reportedly 6.5%, they may not be growing as quickly as they can, and some of their stimulus may not be as effective there as it is here.
Joe Duran, you mentioned the valuation and how we're at 17 times now, and that's where we were before the sell-off. But is the fact that we've gone back to those levels confirmation that that's a place the market is comfortable being, whether it's because of low interest rates or other factors today?
Yeah, I think it's a fair reflection of how we think the economy is doing. I think, when we're sitting at this level, there are a lot of stocks that are still significantly below their peaks, including the Russell 2000. And I totally agree with Ron. The dollar keeps going up. People's interests will go back to small caps. And what typically happens, and I think leads the next leg up, is that a lot of the things that have not participated, healthcare hasn't done well, financials haven't done that well, that you'll see the market now, the money broaden out, and the indexes continue to go higher, but maybe a different group of leaders because there's a change in the way the economy is going. I think, again, it looks like the first quarter was fine. Earnings have been really a pleasant surprise. So I think you'll start seeing ratcheting up of earnings, most especially if the dollar can just hold steady and the rest of the world finds its sea legs, then we're in really good shape for the rest of the year.
Steve Liesman, go ahead.
Just real quick, the one thing, with respect to earnings, I mean, since they were looking for down 2.5% in the first quarter and they came in flat, that was a very low bar to clear. With respect to valuations, Kelly, it's interesting. If you go back to the old days.
Wait, if earnings came in better by 2% on any other, I mean, that's better than expected.
Well, yeah,
I don't care if it's negative.
Well, of course. Well, no, I know. But what I'm saying is the bar was considerably lower than it was a year ago. And so they were still beating tough comps. I get that. But going back to the 1980s when Peter Lynch talked about valuations, he said if you subtract the rate of inflation from the number 20, that gives you a fair PE for the market. So right now that would be anywhere between 17.5% and 19%, depending on your measure. So it's an old rule of thumb. It's one we've kind of forgotten about, but may help explain what's happening right now.
Do you agree with Joe about leadership in the markets changing, or would you stick with it?
I mean, I'm not sure how much you want to get behind healthcare. I mean, it is an interesting contrary trade or contrarian trade, I should say. But again, there's some political issues out there in the future that may constrain that group.
Indeed, Steve Liesman has rejoined us. You said that out there at that Hoover Institution conference, the folks you're talking to, they're not particularly worried about the tight job market. They're not worried about the economy overheating. They don't seem to be worried, overly about inflation. Is there anything that any of them are worried about?
You know, there's some stuff about the corporate bond market they've talked about in the past. There is, by the way, a pretty much agreement, not along with your question, but that some of the overseas risks have also dissipated. There's a sense that, the market kind of had it wrong in December when it was so certain about a recession. That said, Jim Bullard also pointed out something that, if you guys could put up a chart of the 10-year going back to, say, the fall, there have been 75 basis points of easing that has happened to the economy since over the past 5 or 6 months. I think that's significant in that the Fed's change of policy has helped the economy. It's eased off quite a bit. There's that chart right there. And you can see it was 350, 330, somewhere in there back November or so, and it's come off quite a bit. So there's not a lot of concern. There's a sense that they have the luxury of waiting to figure out what the right way to go is, right, Tyler, and they're not in a particular hurry to do anything.
All right, so may I for one second? I don't know if we have the time. Real quick, okay. So what Steve says is exactly true, but the fundamental issue about whether or not the market overreacted to the risk of recession in the fourth quarter, they were looking for the Fed to tighten 3 or 4 times this year. Right. The European Central Bank to start tightening, the Bank of China to start tightening, Bank of Japan. They were looking at all these things. The credit markets were seizing up a little bit.
Go ahead.
Ron, the issue is that the economy didn't weaken as much as anybody thought, and there's no way that any of that policy stuff but that's not the point. The point is that there's no way that any of the change in policy had an effect on first quarter growth or even growth today. I think the economy is the thing that didn't underperform. The market was expecting weakness. It hasn't happened, and it's not really expected as much anymore.
I would just add one thing that's helpful for everybody. The Fed not dropping rates, keeping things steady, gives them powder if things go sideways at some point. So the talk of them proactively dropping rates, it's comforting to me to know that the Fed has room to give if necessary. And so, again, there's no reason for them to drop rates. And it's comforting for them to know we've got things we can do now because we've got rates more normalized. So I think it's a really good thing for us to be in this place.